Today, I want to record a quick video about what I'll call the dividend fallacy in retirement. And the general premise is that a lot of people, when they get into retirement, they want to focus on stocks that have the highest income because they feel like that will prevent them from being forced to sell when prices go down. What I want to highlight to you is that just because something has a dividend does not mean it is the best investment for a retiree, simply because total return is far more important than the dividend yield. Here's a couple examples just based off of some websites that I've got pulled up. So first, you're going to see articles like this if you ever go to Yahoo Finance, CNBC, Fox Business, Bloomberg, you name it. There's going to be something that says something like this. Want $300 in super safe dividend income in 2024? Invest $4,000 in the following 3 high-yield S&P stocks. The premise is, obviously, if you want dividends and big dividends, you just have to be in some names that haven't, or some companies that haven't lowered their dividends in a long time. It gives the example of Verizon, Altria, and I think Realty Income. But for the purpose of this conversation, we're going to focus on Verizon. So Verizon is a name that we've all heard of. It's a very large company. They advertise all the time. It feels like it's going to be around forever. And if you look at the dividend, it pays 6.83%. So a retiree looks at that and goes, oh my God, if I put $1 million into Verizon, I'm going to make $68,000 a year in change, plus I will get the appreciation of the stock market. That feels like a safer bet than being in something like the S&P 500, which pays under 2, or Berkshire Hathaway, which pays 0, or any of the other names that pay less. I want to point out here why that is not necessarily the case, and retirees are better off diversifying their equities even into some names that have lower dividends, because at the end of the day, the total return, the price appreciation plus the dividend income, is the thing that matters most. So again, we looked at Verizon and we looked at it had a over 6% dividend. That sounds amazing, but here is a, let's see, I think this is a 2-year chart, or actually, I'm sorry, this is a 5-year chart for Verizon. And each of these letter Ds represent a time when a dividend was paid, but this green bar up here represents the S&P 500 over time, and this blue line represents Verizon's share price. As you can see, over the last 5 years, it has consistently gone lower. Because the thing about a dividend is that when a stock pays a dividend, its price drops by a corresponding amount. So if a stock pays a 5% dividend, on the day that it has its ex-dividend date, you would expect to see the price drop by 5%. So the dividend that you receive is not necessarily in addition to all the appreciation you're going to get. It is just basically automatically taking that appreciation and sending it to you in the form of a dividend. So in this case, if you bought Verizon stock 5 years ago, you've received income along the way, but the value of your account that started at $1 million is down roughly 33% if you have been spending that income. On the other hand, if you had the S&P 500, you were just spending the income, your value is at nearly 1.7 million. Obviously, if you needed to pull some extra, you could. You could take some additional funds out of the portfolio and still watch your portfolio increase. Now here, this is just a longer term chart showing the exact same thing. So here, Verizon, over the last 10 years, your 10,000 has turned into 13,000 if you were reinvesting your dividends along the way, so you were not spending the income, and your annual return has been 2.8%. Berkshire Hathaway, on the other hand, here we have the Berkshire A shares. Berkshire, Warren Buffett famously does not pay a dividend. Your 10,000 over there is worth 31,000 now. The annual return has been 12.3%. So as a retiree, you have to think to yourself, would I rather have the one that pays 6.8% in cash flow, or the one that pays 0% in cash flow but is up 12%, whereas the other one in total return is only 2%? Now, if you're thinking to yourself, how do I get income out of these portfolios if the stock market goes way down? Because with Verizon, you're not forced to sell. It's going to be paying you out your income. And that's where portfolio management comes into play. You never want to be so invested in the stock market that you have no other safe money to pull from when the stock market goes down. So in a scenario where you're a retiree and you have, let's say, almost all of your money in the stock market, and you were in something as broad-based as the S&P 500 or something that doesn't pay a dividend like Berkshire Hathaway. If the stock market goes down, which it inevitably will, once every 4 years we expect to drop. Once every year it's going to go from some peak to some trough down 14%. Once every century it's probably going to go down 50% or more. That being said, you have to have a position where you can take safe assets from. So in a year when the stock market's going up, blowing and going, you can trim some of those gains and use those for your spending money. So again, in a year when the stock market's up 20% like it was last year, if you need 5% distributions, you can take, let's call it your 1 or 2% dividend distribution, and then trim 3% from your appreciation and use that for spending money. In the event that the market is down, you want to have a reserve of safe assets, cash, short duration bonds, something that is not going to be down when the stock market is down that you can pull from in the interim. So generally speaking, if the stock market goes down and stays down, you are going to draw down that reserve of safe money until it is almost nothing potentially and allow the stock positions to come back higher. And when they do, you will sell those stock positions and refill your safe money bucket. That is a more advantageous way to invest in stocks as a retiree. And we saw that last year. So this was the chart that I had on my previous seminar. And what we're looking at here is the fact that last year in 2023, quality stocks were up 33%, whereas the S&P itself was up 20-something and change. But what do my retiree clients want, or what do all retirees in general want when they're focusing on the stock market? If you have their two favorite things, you would say, I want stocks that have high dividend yield or minimum volatility. So whereas it seems like last year, any monkey with some darts could have basically had significant returns in 20% or more, that's not necessarily true. One, there was a lot of volatility last year. We had bank failures, we had government shutdowns, auto worker strikes, Israel, Hamas, Russia invading Ukraine, speaker controversies in government, you name it. There was a lot of reasons to be scared last year, and yet the market did well. However, the area that did best is quality stocks. The areas that did the worst were high dividend yield payers and minimum volatility stocks. So again, as a retiree, you may enjoy the fact that you had nice dividends, but I can pretty much be assured that you would rather have gone up 33% and pulled some income from there as opposed to only having 10% returns and having a significant income from there. So again, this is an important thing to keep in mind. So when I say quality stocks, what are we talking about? Here is, again, when we're doing the seminar based off of the internet, you're going to get some delays, but this is a quality factor tilt. As this says, what is quality? These are companies that exhibit positive fundamentals, high return on equity, stable year-over-year earnings growth, and low financial leverage. And so when you look at the companies that make up this ETF, you're looking at Visa, Nvidia, Microsoft, Apple, MasterCard, Meta, Broadcom, Eli Lilly, Nike, United Healthcare. These are companies that are considered quality companies. They're names that you know. But when we go up here into the yield, you'll see that the trailing 12-month yield and the current SEC yield is only 1.2%. So again, if you're focused just on high dividend payers and just focused on the income that those generate, you are potentially leaving a lot of money on the table for your long-term growth. So at the end of the day, it's not just how much cash flow does a position distribute on an annual basis, it's how much cash flow did it distribute, but also how much did it go up in value. As an investor, those are the two ways to make money, and you cannot just focus on the income component if you want to have long-term success. So again, if you have questions about this or anything else, please don't hesitate to reach out, and we'll be happy to go over this in more detail. Thanks. Have a great day.